Hello, this is John Smallwood from Smallwood Wealth Management, located in Red Bank, New Jersey. Today we're continuing on the 19 Sources of Retirement Income Guide, and we're focusing on real estate rental income today as part of one of your 19 sources of retirement income. With the recent tax law change from 2017, the rental income does benefit from qualified business income. And generating rental income in most cases is a business that we're really focusing on smaller properties, not investing in a real estate investment trust or something to that nature with this conversation. So as a rental property and having a rental property, I think one of the most important parts of owning any rental property is the income that can be derived from owning that property. Whether or not you pay cash for the property is a whole other conversation and unique value of money. But when we start thinking about a property, there's rents that can be generated based upon the quality and the location and the location and the location of that property. And that rent that you're going to be able to generate is going to be market driven and have the ability to hopefully raise over time. But you really have to understand is how much income am I earning from the rental property? So if I get gross rents of $50,000 and I have real estate taxes and maintenance and legal fees and utilities, etc., that are greater than the 50,000, then I'm violating one of the key principles of owning real estate. It should be income producing, and that income for the risk that you're taking in the rental property should be greater than what I can earn in essence, investments that I could make on a publicly traded market on the same asset class. There are, very unique things coming from having rentals, whether they're apartments or they're corporate, rentals, small businesses, gas stations, lots of different opportunities here. But there's a whole conversation that we would have about asset protection and ownership formats and use of LLCs, et cetera. But this is more so focused on having that rental income coming in, utilizing it. When I own that rental property, there's very unique tax treatment under the current depreciation rules. And you have cost segregation now with the depreciation rules that allow you to take different pieces of that property, such as windows and roofs and driveways, and depreciate them over different time frames, basically accelerating the tax benefits. So let's say you have that rental property that's producing 50,000 and it has $20,000 of expenses, and you're making 30,000 after those expenses. The depreciation that you're able to generate from the property is going to offset that 30,000. So you might have 15,000 of depreciation, so you're only paying tax on 30. So that's extremely tax efficient. The tax benefits for a property, there's a lot of really good things that you can do to a property to improve it, increase your tax basis. You can like kind exchange it under the 1031 exchange rules. You can benefit from selling it at capital gain and reinvesting back in an opportunity zone that is available. That rental income can be used for doing other things in your plan, buying additional properties, paying down debt. The use of debt in a rental property is really interesting because if you think about the mortgage interest is fully deductible to the extent of the loan, unlike your primary residence, which is limited to $750,000 in the current tax law. If you had a mortgage above that to $1 million prior to the new tax law, that mortgage is still deductible. Home equity lines are not. But the buying real estate gives you the power of leverage. And that leverage, let's say that I have $500,000 to put into a piece of property. I can buy one piece of property for cash and generate my rent and pay all my expenses, or I can use leverage and buy two pieces of property or one larger property worth $1 million and you borrow money from a bank and get the benefit of the mortgage interest deduction and the increased depreciation and the increase in appreciation potential on the value of the property. Real estate does not go up in all markets. It could go down, it could go sideways, it could go up. But in the long run, why you're buying a rental property is to generate income, it's to generate tax benefits, and it's to generate appreciation. All three of those things must be part of the ownership of that. And in retirement, having rental properties and having income coming in can be a wonderful thing depending upon your level of activity and your level of involvement. And all that can be handled by, outside entities and people to take it, to take care of all the, property managers, et cetera. But rental income with the qualified business income in the moment is a wonderful tool in depreciation, not to have a lot of taxable income, but yet have good cash flow. So you want to, not rental properties are not right for everybody. They require, lots of improvements over time. They require ongoing maintenance. They require coordination. They require fixing things. They require a lot of things. It's not just set it and forget it. But understanding how to maximize your properties, maximize the cash flows, maximize the tax benefits, and own them in a way that they're as passive as they can be is a really beneficial thing in your plan. And could be right for you, it could be wrong for you. It depends upon who you are and the way your plan and the way your time is allocated. In the planning process, one of the things that we want to look at is when a person has rental income, what are the tax benefits? What's the efficiency of that? Can you make it more efficient? Can you increase rents? Can you decrease expenses? Can you make it a better, more performing asset? Usually, yes. Can you get more asset protection from it? Yes. When I sell rental properties, I benefit from the capital gains. I benefit from, or I don't benefit from, the depreciation recapture at 28%, but you benefit from the lower tax brackets also, potentially. So having real estate that you manage might be a great retirement thing for you. Then again, it may not be. But understanding the benefits of it and the benefits of your current real estate and how it can be maximized is super important. So I encourage you to take advantage of our wealth curve conversation and see, where you are in relationship to the 19 sources of retirement income and what things can you do today to expose yourself to these areas if you're interested in that, and get yourself to a point in retirement where you have multiple sources of income coming in that will be growing and increasing in retirement, potentially, depending upon what happens to rents in the future. Rents do go down. Rents do go sideways. Vacancies can create a lot of problems. So there's a lot of pros and cons, but the idea is, if this is something you're interested in, what you should understand is, how do I buy it and how do I achieve the principles of it, which is generating the income, generating the tax benefits, and getting the appreciation. I don't want to buy a piece of property and have it negatively cash flow. That's really going to detract from my other 19 sources of retirement income. It must be a positively cash flowing property, period. You could turn your house now into rental income by Airbnb. There's different things that you can be doing to generate additional income by getting different rents. Look forward to talking to you. Look forward to understanding about your plan and how we can be of help if that's the case. Talk to you soon. Have a great day. Welcome to the end of the video. Smallwood Wealth Management is an investment advisor representative. The opinions expressed by Smallwood Wealth Management and guests on this show are their own. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Information presented for this educational purposes only. Moreover, no listener should assume that any discussions or information presented serves as a receipt of or substitute for personalized advice from Smallwood Wealth Management or from any other investment professional and is not intended as an offer of solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Smallwood Wealth Management is not a law firm or an accounting firm, and no portion of this presentation should be interpreted as legal, accounting, or tax advice. Information expressed does not take into account your specific situation or objectives and is not intended as a recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Thank you for listening.